Good afternoon and welcome to another Options Play webinar. Today's topic is how to trade credit spreads. My name is Scott Green, Marketing Director with Regal Securities, and soon we'll be joined by our presenter who does all our Options Play webinars, Tony Zhang. Today's topic of how to trade credit spreads, we'll be going over what are vertical spreads, who should trade credit spreads, credit spread management, and more. For those who are unfamiliar with OptionsPlay, it's a highly integrated tool on your trading platform that you can access to help you with your analyzing and researching for trading options. And shortly, I'll be introducing Tony, and he'll present on credit spreads using OptionsPlay. And then we'll have time for Q&A at the end. If you have questions at any point, please submit them through the chat box, or there's a Q&A box which you can also submit them. And then we'll get to as many as we can at the end. Now, I just want to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. And now I want to introduce Tony Zhang, the Chief Strategist at OptionsPlay. And like I said, he's been kind enough to do all these OptionsPlay webinars for us and give us great insight into the different strategies using OptionsPlay and sharing all his expertise on that. Tony has many years of experience in the financial services industry. He oversees the developers at OptionsPlay, and they've developed some of the most innovative tools in options trading and analysis. And that OptionsPlay is their flagship product, which is embedded with several major sell-side brokerage firms, as well as a direct-to-consumer platform. Excuse me. And Tony's helped build up the product suite and has helped develop and manage many of the firm's partnerships that use OptionsPlay. And just in case you haven't accessed it before, you can find OptionsPlay on your trading platform, and it's in the tab right there circled. If you're having any trouble locating it or can't find it, or for whatever reason it's not appearing on your live trading platform, because it is just for live trading accounts only, please contact the brokerage customer support and they'll assist you. So without further ado, I'll now hand it over to Tony.
Thank you, Scott, and thank you everyone for joining me this afternoon. Let me just share my screen here. So thank you, Scott, for the introduction. Like you said, my name is Tony Zhang. I am the Chief Strategist here at OptionsPlay. It is a great tool that you guys all have access to free of charge with your Regal Securities brokerage account. So today what we're going to go over is how to trade credit spreads. I'll talk about a little bit about the strategy itself, how to construct it for those of you that are brand new. And then for those of you that have some experience trading, I really want to get into the nitty-gritty in terms of the best practices for trading these types of strategies, when you should utilize them, how you should utilize them, and most importantly, how to manage these trades once you're in them. Credit spreads are have a large variety of how you can trade credit spreads. So I want to cover what are the use cases, what are the differences between the different types of credit spreads that you can sell? And then more importantly, what I actually want to do is spend most of my time showing you how to actually analyze different credit spreads on your screen using OptionsPlay so that you guys can be self-sufficient in using the tools that are available to you at Regal Securities to analyze credit spreads and be able to trade them effectively. Now, before I go ahead and get started here, if you could just type into the chat window credit if you have traded credit spreads before, and type no if you're brand new to credit spreads, just so I get a feel for who's in the room. So please type that into the chat window. Okay, so it looks like Many of you have traded credit spreads, but actually a fair amount of you have not traded credit spreads before. Okay, great. So for those of you that have never traded a credit spread before, I will start with an introduction of kind of what it is and how do you structure one. For those of you that have, we'll talk a little bit about how to actually how to go about analyzing a credit spread, what are the best practices for picking expiration dates and strike prices, and then more importantly, how to manage them once you're actually in the trade. And then what we'll do is we'll go over the actual trading strategies using OptionsPlay, showing you some real life examples using some real stocks, so that after this webinar, you will have the ability to actually log on and start analyzing some of these trades for yourself, even if you're brand new. And for those of you that have some experience trading, this is really designed to help you save some time, because sometimes analyzing these using the option chains sometimes can be very time consuming. So we want to show you a different way of how to analyze these types of spreads. So we'll cover today what are credit spreads, when to use them, how to trade them effectively, and then credit spread strategy management. That's really what we want to cover here today, along with using the OptionsPlay to show you the things that we're teaching. So we're going to start off with what are credit spreads. Credit spreads are two different types of vertical spreads. These are the bull put spread and the bear call spread. These are both vertical spreads that result in the credit to your account to enter the trade, and it results in a debit to exit that trade. That's why we call them credit spreads, because you receive a credit to enter these trades. And the bull put spread is the trade that you want to enter if you're bullish on a specific stock or index or ETF, and the bear call spread is the trade that you want to make if you're bearish on a stock, ETF, or index. So how do you actually construct one of these? Before I actually get into the actual construction of it, and there's a lot of numbers on your screen, but before we get into the actual numbers, the one thing to remember about credit spreads or any type of vertical spreads is the fact that we trade them because they have limited risk and reward. That is one of the key things about trading credit spreads or any type of spread, is the fact that you have a predefined risk and reward before you get into a trade, so that no matter what, you will have an expectation of what is the best possible scenario and what is the worst possible scenario before you get into a trade. Unlike other forms of trading where you buy a call or a straddle or anything with unlimited risk or unlimited reward, you don't know what you'll end up with. You don't know how much potential reward or potential risk you can have. And sometimes that's difficult as a trader to plan for that. So that's really why I like trading vertical spreads more than anything, because I know exactly what my maximum risk is, what my maximum reward is, and that helps me plan for my trading. And credit spreads is very similar. So what I have here is a fictitious stock XYZ trading at $100. I'm going to use this stock to help you understand how to structure a credit spread. Now, I'm going to go through the mechanics of how to structure a credit spread, but you don't have to memorize this, because our platform actually constructs it for you. So you don't have to know how to structure them. This is just for those of you that want to learn and want to understand how a credit spread is set up. So we have a stock trading at $100. So let's say we're bullish on this stock and we think it's going to go a little higher. Then we might trade a bull put vertical or a short put vertical. And this results, what this strategy is what we're selling is an at the money put. So we're selling a $100 put, and let's say we receive a $4 credit to sell that $100 put. And at the same time, what we're going to do is we're going to buy a lower put, a $90 put. And let's say it costs us $1 to buy that put. What that means is that we now have a net credit of $3 because it costs, we receive $4 to sell the $100 put. We have to pay $1 to buy the $90 put. That net is $3. So we're going to receive a $3 credit. And when we're talking about a credit spread, our max reward is the credit that we receive. So the stock, if the stock stays above $100, we're going to keep that $3 credit. Our max risk on a credit spread is always the difference between the width of the vertical spread. So it's a $100 put versus a $90 put. So the width is $10. The max risk is always the width minus the max reward. So you have a max risk of $7. So when we're trading these types of credit spreads, most of them you'll see that the max reward is significantly lower than the max risk that you're taking on these trades. That's one of the characteristics of selling credit spreads. We'll talk a little bit about why you have this inverted risk reward ratio and why you would want that, or why that happens more importantly. But this is how you structure a bull put vertical, is you sell an at the money put and you buy back a further lower put that receives a net credit, and you determine the max reward and max risk depending on how much credit you receive versus how wide that spread is. Conversely, on a bear call vertical, let's say you were bearish on stock XYZ, what you can do is you can sell the same thing, a $100 call instead of a put, and let's say you receive a $4 credit to do that, and at the same time what you're going to do is you're going to buy back a $110 call, a higher call, to help cap that risk. Let's say you pay $1 for that as well, so your net credit again is $3 in this particular case. And that means roughly the exact same risk to reward ratio, where your max risk reward is $3 because that's the credit you receive, versus a max risk of $7, which is what's left of the $10 wide spread. So vertical spreads are always defined in terms of risk to reward based on the width, and whatever your max risk is, the rest of it is your max reward. And that's really one of the easy things about trading these spreads. A lot of people find spreads confusing, but in reality, it's actually really, really simple to calculate the risk and reward of spreads, because all you have to do is account for the width, and then whatever your max reward is, you can easily calculate your max risk as the difference between that and the width of the spread. So what are credit spreads? Meaning, why should you trade them? And the reason for this is, you generally trade credit spreads because you're trying to generate a consistent income stream. Because when the credit that you receive, you can think of that as collecting income. And the goal of selling credit spreads is to sell the credit spread for a credit, let that trade expire worthless, meaning so you keep that $3 credit, you keep that $3 income, and then what you want to generally do is rinse and repeat this as many times as possible and collecting a steady income stream. So that's the goal of selling credit spreads. Now, what we want to now look into is the mechanics of how to go about doing this and when you should enter these types of trades in order to help you generate a consistent income stream by selling credit spreads. So talking a little bit about the best practices of this strategy, just general things to look out for when you're selling credit spreads. As a general rule of thumb, selling credit spreads on ETFs and index options, generally speaking, results in is generally preferred when it comes to selling credit spreads versus individual stocks. And the reason for this is really because when you're selling credit spreads on ETF and index options, you don't have to worry about corporate actions. You don't have to worry about news announcements coming out. You don't have to worry about product launches that may impact individual stock prices significantly. Indices, generally speaking, don't move that much in reaction to small micro type news events, especially certainly corporate actions don't affect it. So that's why, generally speaking, when you're selling credit spreads, you don't want the stock to move very much, or you don't want the ETF to move very much. So ETFs and indices generally are a little better for that because they tend to have less gaps than selling credit spreads on individual stocks. When you're selling credit spreads, you generally want to do shorter dated options. So usually 2 to 5 weeks out is traditionally where you would sell a credit spread. So the weekly options is the crux of where credit spread traders are trading, is that 2 to 5 week. And the reason for this, again, is because short dated options will maximize theta, or the time decay. Time decay is working in your favor when you're selling options, and that's primarily what you're doing when you're selling credit spreads. So you want to maximize that theta, and that happens in the last few weeks before expiration. When it comes to picking strike prices, this is really where you have a lot of flexibility, because you can choose out of the money strike prices, or generally speaking, you would always sell out of the money strike prices. But the question is, how far out of the money do you sell? So this is really where we have to talk a little bit about the relationship between probability and risk to reward. So when you're selling credit spreads that are very close to the current price of the stock, or what we consider near the money strikes, you generally will have a lower probability of profit, but you'll have a better risk to reward. Conversely, if you were to sell credit spreads that are very far out of the money, meaning credit spreads strikes that are very far away from the current price, we consider these very far out of the money strikes. These credit spreads will have a significantly higher probability of profit, but the trade-off here is you're going to have a much worse risk to reward ratio. So what we really want to do is understand the relationship between probability of profit and risk to reward, and really try to see where we find the right balance between these two, because we don't necessarily want something that's too low probability of profit, nor do we actually want something that has very high probability of profit, because the trade-off there is you're going to get significantly worse risk rewards sometimes, where that just one trade that goes against you blows out 10, 20, 30 previous trades that you made before that. So we really want to make sure we find the balance between the two. So let's look at the kind of the balance and kind of what that looks like. So when you sell a near the money credit spread, the first thing we want to understand is that with all options trading, doesn't matter if we're trading credit spreads, debit spreads, or just buying calls and puts, is that we're always trading off between probability and risk to reward. So what we want to do is actually look at what the probabilities look like, what the risk reward looks like, so that we have a better understanding as to what we're looking for. So when we're selling near the money options, so calls or puts that are very close to the current price, and then buying back a call or put that's relatively close to the current price, what we're generally going to find is something that looks like this, where the probability of profit is about 67% winners, 33% losers. And with these types of probabilities, what you typically find is that you're going to risk roughly about $200 to make a $100 credit on the trade. Okay. Conversely, if you sell far out of the money options, what you typically see is significantly higher probability of profit, where you're risking, where you have about 90% of your trades are winners, or 90% probability of winning, and only about a 10% probability of losing. Now, a lot of people will say, well, why wouldn't you always just trade to something that has a higher probability of winning? And the answer is that it's not that simple, because the trade-off is you're going to have a significantly worse risk reward. So it might be nice to win 9 out of 10 trades, but what if that one losing trade wipes out the previous 9? Is that worth it? Probably not. And that's generally what we find when we go too far to the extreme of going far out of the money. You can even find trades that have 95, 99% probability of profit. But and that might be great, that those 95, 99% of the time, but we've generally found that though that 1% of the time when the stock market really just goes against you, or for whatever black swan event that happens that goes against you, you're likely going to wipe out a lot more than what you've made over the previous 95 or 99 trades. So that's why we generally, based on our back testing, find it much better to be near the money, where you're risking just twice the amount that the credit that you receive, so that no matter what, even if the market really moves against you, you're not blowing up your entire account. You're only wiping out the last couple of trades. You're not wiping out the last 50 or 100 trades, which is what you're generally going to see when you're trading these very far out of the money credit spreads that give you a high probability of profit, but a very, very poor risk reward ratio. So based on all of our back testing, based on lots of different things, and like I said, you can trade near the money options, you can trade far out of the money options. Even when you trade near the money options, you can trade different widths. You can trade the distance between the buy strike and the sell strike can be different varying lengths. So there's a lot of variability into this type of strategy. So the rule of thumb here, generally speaking, is that you want your credit received to be roughly 1/3 of the distance between the strikes. What that means is that if you're selling, and that generally looks something like this, where you have roughly a 67% probability of profit, and you're risking roughly $200 to try to make a $100 credit. So what that means is that if you're selling a credit spread that's $3 wide, you want to receive roughly about $1. That will help you determine how far out of the money you want to trade. And I'll show you guys this in a few seconds using OptionsPlay, because OptionsPlay is really designed to help you play around with the different strikes depending on how wide they are and how far out of the money, to allow you to quickly find these types of verticals or credit spreads that meet this criteria of credit received is roughly 1/3 of the distance between the strikes. So I just have listed here a few of the more popular strikes that you would typically sell. $3 wide strike, you're trying to receive roughly $1 in premium, $5, $1.67, $10, $3.33, and so on. So this is all designed to help you, just give you a guide for roughly the amount of credit that you want to look for when you're selling these types of credit spreads. Now, you don't have to memorize this, but just remember, as a rule of thumb, 1/3 of the distance between the strikes is what you're typically looking for to receive in credit. So now that we talked about the mechanics of what a credit spread is, what are the best practices, what type of expirations and strike prices should you look for, when should you actually implement these strategies. That's actually one of the things that I actually find a lot of people tend to, I wouldn't say misuse, but I find that people are not utilizing this correctly. Credit spreads are best used for when you expect a neutral or modest move in one direction or another. Now, that means that you can sell credit spreads as in pretty much in many different conditions. However, credit spreads are best used when you find that the stock is either overbought or oversold. And this is because you want to have some directional edge when you're selling credit spreads, because that's how you're going to be able to overcome the risk to reward versus the probability. Is if you have any sort of directional edge, and a lot of times many of you use technical indicators to trade. So if you actually use technical analysis such as MACD or RSI or stochastics or any of those oscillators that tell you overbought and oversold, please type into the chat window which ones you use. Please type in MACD if you use MACD or stochastics or RSI, just so I get a feel for what type of technical indicators you guys use for trading. Because when you're looking at overbought, oversold, these are optimal times to consider entering these types of credit spreads. A lot of times when you've identified a market top or bottom, also great times to consider entering or exiting or entering a credit spread. And the key thing here is that you actually do not want to use credit spreads when you're expecting a large move in the underlying. And I'll show you guys why. You only want to utilize this when you expect that the stock's not going to move a lot, especially if you feel that it's not going to move in one direction. So for example, if you feel that a stock is oversold, you should sell a put credit spread because you don't think the stock's going to move any lower. Conversely, if you think it's overbought, you should sell a call credit spread because you don't feel the stock's going to move any higher. For those of you that use price action like support or resistance levels, and you've identified a double top or double bottom or triple top or triple bottom or head and shoulders, any of these are all potential uses of credit spreads when you feel that when you've identified a reversal pattern. And the key here is that if you're bullish, you want to sell a put credit spread. If you're bearish, you want to sell a call credit spread. So let's actually move on and talk a little bit about, just illustrative purposes, kind of what are the best ideal conditions for selling credit spreads. And I want to put this or frame this in conjunction with debit spreads, because a lot of people get confused between the two, and they are very different strategies. And I want to make sure everyone understands that, because I want to make sure you're using credit spreads in the right conditions, and you don't want to be using credit spreads when perhaps a debit spread is better. So here I have a scenario where a stock was, or this was, I purposely did not name the stock, but this was a stock or ETF that was trading in a big triangle that was consolidating into an apex, and finally it broke out. So these types of breakout trades, when you're expecting a large move in one direction or another, which we typically see when something trades in a tight range like this, these are generally best utilized a debit spread for, meaning this is not the right time to use a credit spread. Conversely, when you have a range-bound market where you've identified clear support and resistance levels, and you feel that the stock has hit that next support level, that is an ideal time to sell a credit spread, because you don't necessarily know the stock's going to make a huge move, but you're pretty sure that it's not going to move much lower. So here I found support around 101. So when that stock moves down to that 101 level, that's a good indication that it's unlikely to go much further below 101. It might bounce higher, but there's no indication of how far it's going to go. So that would be an ideal time to sell a put credit spread. When it reaches the top of that range, that's a good time to sell a call credit spread. When it goes back down to the range, sell a put credit spread, and vice versa. And you can continue to do this. And this is really why credit spreads is the strategy that allows you to generate consistent income, because debit spreads you can only trade when you expect a large move. And that doesn't necessarily happen very often. Credit spreads you can trade much more often. When the stocks are in a range-bound range, you can continue to sell call credit spreads and put credit spreads and string them together. You can even sell a put credit spread before your call credit spread has even expired. And that's really one of the differences between trading credit spreads and debit spreads. And I hope that this chart helps illustrate that you can sell credit spreads traditionally much more often than you can trade debit spreads, but you should only use them in certain market conditions. And it's really important to understand when those conditions are in order for you to maximize your profits from selling credit spreads. Because if you sold a credit spread here, you would have ended up risking a lot more money than you would have collected, even if you were correct on that trade. Debit spreads allow you the inverse risk to reward ratio, significantly less risk and significantly higher reward if you're correct, which is why they're better for when you're expecting a large move. So now that we've gotten that out of the way, let's talk about how to manage a trade effectively. So the key with all spread trading is really that risk management is key. So the entry we talked about, entering a credit spread, is what we should time them with when we expect a market top or bottom. This can be done using technical indicators. This can be done using oscillators. Whenever you feel the stock is unlikely going to move much lower or unlikely going to move much higher, that is the time to enter a credit spread. And you can string these calls and puts together. Like I was showing you here before in this previous example, you can sell a put credit spread, a call credit spread, a put credit spread, a call credit spread, and you can do one after another. Even if they haven't expired yet, you can do one after another. And that's one of the key differences between trading credit spreads versus debit spreads. Once you're in that trade, how do you manage that trade? So this is really where the goal of a credit spread is to let that expire worthless and keep the credit that you received. However, that doesn't necessarily always happen because the trade can go against you. So we want to talk a little bit about how you should manage your losses here. So if the premium that you receive on the trade is greater than 20% of the vertical width, so we talked about the golden ratio is to use about 33% of the vertical width is the credit that you receive. So that would fall under this first category of premium received is greater than 20% of the vertical width. Then you want to cut your losses when you've lost about 75 to 100% of the credit that you received. So you received the dollar in credit and it's now trading at $2 or more. That's when you want to get out of that trade. Conversely, if you're selling a far out of the money credit spread where the premium that you received is less than 20% of the vertical width, so this is for those of you that are selling credit spreads that have an 80, 90, 95% probability of profit, you're going to be receiving a very small percentage of the vertical width in terms of your premium. Then you might want to cut your losses at a larger range when you've lost anywhere from 1 to 200%. On the trade. So if you sold a credit spread for $1 and it's now trading at $3, then it's time to consider cutting your losses. So that's really where credit spreads require a little bit more experience with trading, especially if you've never traded a vertical before. Debit spreads tend to have much simpler rules in terms of managing them. But credit spreads, like I said, are very different from debit spreads. So, but they do take a little bit more knowledge of options in order to manage them. So make sure that you are aware of that there are different ways to manage them depending on whether you're selling near the money credit spreads or far out of the money credit spreads. So make sure that you understand the difference between the two and make sure that you have the understanding of how to manage them. I saw one question here, and I hope that I covered this before, but for those of you that missed this, the vertical width is referring to the distance between the two strikes. So if you're selling a credit spread and you're selling the $100 put, and then you're buying back the $90 put, the distance between those two strikes, $10, is the vertical width. So all verticals we talk about in terms of width is the distance between the two strikes. So I want to make sure everyone is comfortable with that and understands what that means, because everything is a relation to that vertical width. It doesn't matter whether you're trading debit spreads or credit spreads. It's really important to keep that in mind. So with that, let's actually take a look at some real examples of some credit spreads that I have, some credit spread examples that I want to show you. And I have one where we can compare a debit spread as well. So I'm looking at Walt Disney first. Now, before I get into the actual trading, I do want to specify that this is the OptionsPlay tool. You guys have access to it free of charge with your Regal Securities account. You can find it under the OptionsPlay tab here in the upper right-hand corner. If you don't have it, you can always click on Add Widget and click on OptionsPlay. That'll allow you to add this widget. This tool is designed to help make your options analytics and finding strategies much simpler compared to looking at an option chain. Because when you're looking at an option chain, you have a lot of different expirations, a lot of different strike prices. It's quite intimidating, I would say, for most beginners to use this type of screen because it's difficult to understand exactly where to start. let alone once you learn how to read this type of screen, something like as simple as comparing one vertical spread to another vertical spread is not always apparent. So if you're trying to figure out whether you should sell the 34, 36 credit spread or the 35, 37 credit spread, you can't do that type of simple analysis using the option chain. And that's really why we created OptionsPlay. Not only did we want to provide you with starting points, we wanted to provide you with the tools so that you can quickly analyze one strategy against the next so that you can definitively say which one's best suited for you. So I'm looking at Disney here because for those of you that are familiar with technical analysis, I was looking at Disney. This was one of the stronger stocks, or one of the more bullish stocks that recently is what I would consider fairly oversold. So as you can see on the stochastic reading, it's 14, which is well below the 20 level. This is what I consider a stock that's oversold. So these are the types of candidates where I don't think Disney is going to go much lower below 112. I think that there's a possibility it might move a little higher up to that maybe 114, 115 range. Possibly higher, I don't know, but I certainly don't think it's going to move much lower than 112. Now, this is by no means the solicitation to trade Disney. I'm simply providing this trading example as for educational and illustrative purposes. But let's say I was modestly bullish on Disney. How can I take advantage of that? So first off, what I want to do is show you that we will always present to you 3 bullish strategies for any given stock. You can always buy the stock, you can buy the call, and you can buy a call spread. These are the 3 most popular strategies that you would take if you were bullish on Disney. Today, we're going to take a look at a more advanced strategy, credit spreads. And what we want to do is actually compare them with perhaps that debit spread to show you the difference between the two. So what I'm going to first do is I'm going to click on modify because I don't want to buy a call. I certainly don't want to buy the shares. I'm going to use my strategy constructor. I'm going to click on I'm bullish, and we're going to sell that put vertical. This is the credit spread that we would want to sell. So by default, what we're going to do is we're going to look at, let's take a look at maybe a $3 wide spread. Or maybe, let's look at a $3 wide spread. So we talked about trying to collect about 1/3 the distance between the two strikes. So 111, 114 is a $3 wide strike. That's going to collect me $1.41. That's a little bit more than what I'm looking for. So what I'm going to do is I'm going to move my strikes down a couple and see. So here I'm at the 109, 112 strike. This is going to collect me about 93 cents. So roughly about the dollar that I'm looking for, which is 1/3 of the distance between the width. So this is usually a good starting point for me to analyze. And then what I can do is I can maybe look at a different spread. Let's say I want to look at maybe a 5-point wide spread instead of a 3-point wide spread. Where do I have to? So on a $5 spread, I'm looking for about $1.67. So here I have to go to the 108, 113. So these are 2 possible credit spreads that I can trade. If, let's say, I'm bullish on Disney, this allows me to compare the 2 side by side. And what I'm also going to do is I'm going to leave the debit spread here on the right, just for comparison purposes. And in order to compare debit versus credit spreads, what I first have to do is make sure I'm risking the same amount of money. So let's say I'm willing to risk $2,500. So here what it tells me is I can sell 7 contracts of the 108, 113 credit spread. I can sell 12 contracts of the 109, 112 credit spread, or I can buy 9 contracts of the 111, 118 debit spread. So let's look at these 3 trades side by side. As you can see, the risk amount for each one is roughly the same. One is risking $2,400, one is $2,480, and one is $2,376. So very, very close in terms of expected max risk, but very different potential risk max rewards. So each one of these is roughly collecting about $1,000 here in profits. My max reward on the debit spread here is actually $3,900. So let's actually take a look at the difference between these strategies and see what they actually mean. So Disney's trading at 111.94 on the close right now. So let's first start off with the scenario of, let's say that Disney doesn't move at all. What is my expected profit? So here, if the stock stays exactly where it is around 112, as you can see, if I traded this credit spread, I'm going to make a 98% return where I'm collecting pretty much all the profit that I can possibly collect, about roughly $1,100 in profit on this particular trade. If I chose the $5 wide spread here, I'm only making 38% return. So right off the bat, if the stock stays exactly where it is and it doesn't move very much, as you can see, that spread that I was looking for, roughly 1/3 the width of the trade that I'm making here on a $3 wide spread, that's really where I'm going to make what I'm really looking for, the highest return. If I bought this debit spread, as you can see, I've lost 62% of my trade, so I've lost $1,400. So clearly, if I think the stock's not going to move anywhere, I should not trade this debit spread. I should consider one of these two credit spreads. And if you ask me, I would certainly choose the one that gives me the higher return. This is why we created this platform, because when you're looking at an option chain like this, it's really difficult to say, how do you compare two different credit spreads of different widths and different strike prices and know how they perform based on where the stock goes. So we created this P&L simulator so that you can quickly set up any two strikes or any three spreads next to each other side by side and use our P&L simulator to say, what happens if the stock goes higher? What are my expected returns? So before I talked about it, I think modestly this can move at least to about 114 and 115. So let's say what happens if I think it's going to go up to 115. Or let's do 114 first. As you can see, if it goes up to 114 here, I'm both on the credit spreads. I'm going to collect my roughly $1,100 profit that I'm going to receive on each one. Versus here on the debit spread, I'm only going to make a $324 profit. So still, if I expect a modest move, so a small move higher, I'm definitely going to be better off on one of these two credit spreads in terms of trading. This one gives me slightly more profit than this, which is why this one is highlighted blue. Versus this debit spread still is only going to give me a small amount of profit. Now, what happens if I think the stock's going to really take off? What if I think it's going to go back up to that 117, 118 all-time high? So if I think it's going to go up to that 117.90 52-week high, as you can see, now the picture looks significantly different. And that's why we always say you should first look at what your expectation for the stock is, because that's going to help you determine what is the best trade to make. Because if you're expecting a large move, if any of you watched our previous webinar on trading debit versus credit spreads, debit spreads are for when you expect a large move. So if you expect the stock to move up to that 118 level, as you can see here, I'm going to make a $3,800 gain on my trade versus still here, I'm only going to make my $1,100 profit because that's the maximum amount of money that I can make on a credit spread. So that's why I always tell users, if you expect a large move, credit spreads is not the trade to make. You should trade the debit spread. And as you can see, if the stock goes up to 118 by expiration, here I'm only making $1,100. Here I'm making $3,800. So a significant boost in performance on that debit spread if you expect a large move with the same amount of risk. You're risking $2,500 in each one of these trades, but this one gives you significantly higher return if you are correct in the fact that Disney moves higher. And then you can also use this tool to say, well, what happens if I'm wrong? What happens if Disney goes back down to 108 or 107? Here you can see that if you do that, I'm going to risk the same amount of money on each one of these, $2,300, $2,400, and $2,300 right here. So even though the max risk on each one of these trades are the same, the risk profiles are vastly different depending on how far I think the stock's going to go. So depending on where you think the stock's going to go, that's going to help you determine which trade to make. I'm also going to look at, I'm going to bring up another example. Oh, actually, I was going to use the Qs. So this is the ETF that tracks the NASDAQ 100 index. And again, this goes back to my point about when you're trading these types of credit spreads, indices and ETFs tend to be a better instrument for these because there's typically not a huge gaps in these trades. There's no corporate actions that cause extreme moves, which is generally a little better for credit spreads because credit spreads, whenever you have an extreme move against you, you are risking substantially more money than you are receiving in credit. So you want to limit those number of extreme moves, and the best way to do that is trade ETFs and index options. So I was looking at the Qs. Now, again, this is by no means a solicitation to trade the Qs, and this is just simply my own observations. You know, the NASDAQ 100 index has failed to make new highs as the market has made new highs, and momentum is starting to slow down in this as market makes new highs. So this is showing me that the markets are rotating out of tech, and perhaps tech is falling out of favor. So one of the thoughts, so this is usually an interesting use case for selling credit spreads because I don't think NASDAQ 100 can make significantly new highs. So perhaps I'm bearish on the NASDAQ 100. So here what I'm going to do is I'm going to modify this. I'm going to select bearish. I'm going to sell a call vertical. So again, I'm going to look for roughly a third of the distance between the strikes. So let's say I'm selling a $3 wide strike. and I want to collect roughly $1. So what I'm going to do is I'm going to play around with these strikes until I find the one that collects me roughly $1. So here that's selling me 184 and buying back the 187 calls. That's going to collect me roughly $1 while risking roughly $2. And I can again say I'm willing to risk, let's say, $2,000 on this trade. So here I can sell 9 contracts of the call vertical versus if I bought the put vertical, I can buy 8 contracts of the put vertical. So this is the debit trade. This is the credit trade. Both of them risking roughly $2,000. One's max gain is $850, and one's max gain is $5,200. So let's take a look at these trades and say what happens if the Q stay exactly where it is around 181. As you can see here on the credit spread, I received my full credit. So as long as the stock stays where it is and doesn't move much higher, I'm going to receive my credit. If I bought the debit spread, I'm going to lose roughly 2/3 of its value and lose $1,200. So very, very different outcomes if I expect the stock to stay where it is. So very clear that if I expect the stock to stay where it is, I would not trade the debit spread. I would definitely trade the credit spread. However, let's say I think it's going to move back down to, let's say, 178, modest move lower, as you can see here. Even if the stock just moves down to 178, which is where it was just a few days ago. Here on the credit spread, again, I'm only going to make $850. But if I traded the debit spread, I make a $1,200 return. So this is really where you have to ask yourself, and this is really one of the powers of this tool, is that when you're looking at the option chain, you can't compare a credit spread to a debit spread. And you certainly can't figure out exactly when one strategy beats the other strategy, because that's exactly what you need to visualize or know before you can decide, should I trade the debit spread or should I trade the credit spread? So this tool allows you to use the slider and actually see at what point does one strategy beat the other. And the answer there is around 178.25 is when the debit spread and the credit spread is roughly the same profit. Anything lower than that, the debit spread is going to give you significantly higher returns. So the question becomes, do you think that the Qs are going to move lower beyond 180, around 187.30 or so, or lower? If you do think it's going to move significantly lower than that, that tells you that you should perhaps trade the debit spread. If you don't think it, if you think it's going to stay above that level, then clearly the credit spread is better. And that's really why we want to allow you to put any two strategies side by side, compare them apples to apples using the same number of contracts, analyzing it based on the same amount of risk, and seeing based on the P&L simulator, understand exactly where you're going to make profit, where you're going to lose, and how much profit and loss you have, so that you can easily compare the two side by side and definitively know which one's best suited for you, not just making a guess when you're looking at the option chain, because you don't have that type of analytics when you're looking at the chain. You need a tool like the P&L simulator to really help you understand how each one of these strategies perform. And if, let's say, you expect the stock to move lower over a shorter period of time, then maybe that also will influence your views. If you think it's going to make a quick move down to, let's say, 174, then this allows you to quickly see how the debit spread versus the credit spread performs. This helps you make informed decisions about which strategy is actually best suited for you. So what I'm going to do right now is I'm going to open this up for Q&A. I want to answer as many questions as I have time for. But before I do that, I just want to do a quick wrap up. When you're trading credit spreads, make sure that you understand that credit spreads are generally used for when you don't expect a large move in the underlying. You think it's just going to stay where it is or stay fairly neutral. That's when you want to enter it. And I know a lot of you want to chase these high probability risk-reward ratio or high probability of profit credit spreads because you want to have lots and lots of winners, but rarely do those work out for you in the long run because of the high amount of risk that you're taking when you're selling these way out of the money credit spreads. You could wipe out 10, 15, 20 trades in a row just from one bad trade versus when you're selling relatively conservative risk-reward ratios on credit spreads, the maximum you can lose is twice the credit that you receive. So the worst case is that you wipe out the last 3 to 4 trades. That's about it. You're not going to wipe out the last 10, 15, 20 trades, which sometimes can be quite difficult to overcome. So keep those things in mind when you're selling credit spreads. And I hope you guys find this useful. So please, if you have any questions, please type into the chat window, and I will try to answer as many as I have time for. So, what is the margin requirement for trading credit spreads? Great question. The margin requirement is the max risk that you will have on a trade. The max risk is the amount of money you need in your account in order to trade a credit spread. What do the colors around the probabilities indicate on the trade scores? So the OptionsPlay score is the risk to reward metric. This is telling you how well, how good the risk to reward metric of each one of these strategies are, and allows you to compare them side by side. So when you're looking at these types of strategies, you can see here I'm risking $2,000 to make $5,200. Here I'm risking $1,800 to try to make $855. But they have very different probabilities. So that's how we want to normalize all of these different factors. Like I said, with all trading, it's really understanding the relationship between risk to reward and probability and how well balanced that is. The balance is really what you're looking for, and the OptionsPlay score tells you how well balanced that is. How can we practice credit spreads on a paper trading account? Well, a great question. So one of the things you can do is, let's say you want to trade this credit spread. You can hit the trade button, and one of the greatest things that we've built into the Regal trading platform is you can hit preview order, and that will pre-fill a ticket for you. You can use this to paper trade these trades and manage them, and you can trade them on a paper trading account if this is your first time. I know a lot of you said that in the beginning of this webinar that you've never traded a credit spread before, so I highly recommend that you take a look at selling a credit spread, click on the trade button. We have a preview order which pre-fills your ticket for you, and you can send this off for verification and paper trade these for a while until you're ready to start trading them on a real trading account. Can you close out a position early? Absolutely. You can close out a debit spread, credit spread, any option position for that matter. You can close it early. So it's just a matter of either buying to close or selling to close to get out of a credit spread. So credit spread is to buy to close. A debit spread is to sell to close in order to get out early. The expiration date there is September 28th. Isn't that a little long for a credit spread? So yeah, absolutely. So we can certainly look at selling shorter dated credit spreads. So I would say, that September 28th is probably the longest I'll go. I'll probably typically trade that 3-week credit spread is usually where I'd like to be. So as you can see here, if I move this back to a quantity of 1, just for illustrative purposes, I have a $3 wide spread here. So I want to, again, collect roughly about $1. So that means I should sell roughly the 182, 185.5 on a $3 wide spread for the September 14th expiration. That is what's going to collect me that 1/3 of the width of that strike. So you can certainly play around with the expirations and then play around with the strikes to, again, try to find that $1/3 the width of the strikes on any expiration. How about margin hold on credit spread? Same thing. The max risk is your margin requirement on selling a credit spread. Do you use implied volatility as an indicator to place a trade? Great question. I don't, and the reason for that, again, is because the difference between, the only way that you would use implied volatility is that a lot of people will only sell credit spreads when implied volatility is high. A lot of people will only trade debit spreads when implied volatility is low. However, if you use the P&L simulator, you'll see that volatility has a relatively small impact on the overall profit and loss of your trade, even if vol decreases by a third. So here vol's at around 13%. So even if it drops by a third, as you can see, the impact to your P&L is actually minimal. Versus if you expect a move in one direction or another, that impact to your P&L is much, much larger. So I don't use implied volatility because even if I have that implied volatility edge, it doesn't make sense for me to make my decision as to whether I want to trade a debit spread or credit spread based on that alone, because delta is much larger exposure in my opinion, or it is much larger, your delta exposure. So you should always use your directional view as your indicator. I personally don't like to use implied volatility as my indicator to place a trade. Where do I find the recordings? So great question. So we can send you the email. We can send you an email after this webinar with the recordings so that you can see not only this webinar, but also all of the previous webinars that we've done We usually send that out right after usually the next day on these webinar recordings. Can you talk a little bit about more about when to get out or reversing a credit spread? I'm not sure about what you mean by reversing a credit spread, but I did go over when to get out of a trade. So like I said, the goal here of selling credit spreads is to let it expire worthless. However, and that's only feasible when this trade's going in your favor. If it's going against you, here's the rules. You want to cut your losses at either 75 or 100% loss if you're receiving more than 20% of the width of the spread. But if you're collecting less than 20% of the width of your spread, you usually want to give yourself a little higher buffer. So 1 to 200% loss on the trade is when you want to get out of that trade. How exactly do you exit the strategy? Great question. That's a question for your brokerage firm, Regal Securities. I'm sure they'd be if you call them up, they'd be happy to walk you through the actual mechanics of exiting a trade. It's pretty straightforward. It's just selecting the strategies out of your positions tab and clicking on close. Matt's asking, I saw the Qs and it was not at the top of overbought, but at 68% on the way down. Matt, like I said, that was by no means a solicitation to trade that or to say that that's a trade that you should make. I just simply use that as an illustrative purpose as a trade that I thought was near a top. You can disagree with that analysis and view it in a whole different way. I'm just saying that if you felt that the Qs were at a top, here's a trade that you could potentially make, not necessarily making a case that the Qs are at a top. Does the tool calculate the cost by taking the middle, the bid ask, or the last? So what we do is we always calculate based on the bid ask or the mid price. You can structure both of them, both on the natural price, which is the bid ask, or you can select the mid price. So we can do either one for you. Do you recommend using bid, ask, or mid? Great question. So usually we always try to get filled as close to the mid as possible. I prefer using the mid when I'm doing this because I usually like to work my orders to get filled near the mid. Bid ask is usually the worst possible price you can get filled at. So usually you can get somewhere in between closer to the mid in my experience. So I usually like to use the mid. Does eOption have a shortcut to reverse my credit spread? I'm not sure, again, what you mean by reverse. If you mean to close out a trade, absolutely. Call up your broker's desk. They should be able to help you with how to look at your positions and how to easily select your positions and close out your trades. So please make sure that you reach out to your broker. They'll be able to help you figure out how to close out a trade. It's all under your positions and orders. You can select multiple positions and click on close. I believe there was one question here. Are there credit spread trade ideas on OptionsPlay? So all the ideas that we provide are on the underlying stock itself. It's up to you to decide as to how you want to play that. So if you want to play a bullish view using a credit spread, you can do that. If you want to play a bullish view based on the debit spread, you can do that. That's really where we provide you the flexibility. We're not telling you what to do, nor are we a recommendation engine. We're here to provide you with analytics and help you structure these trades so that you can place them side by side and see which one's best suited for you. Any other questions?
Well, great. Thank you very much, Tony. Appreciate going through everyone's different questions. Were there any other ones you wanted to address?
Yeah, it looks like there's one about what happens at expiration date.
Okay.
So if the credit spread expires worthless, there's nothing you need to do. You've collected all the premium. The only thing that you really have to look out for is if it ends up in between the two strikes. That's where you want to make sure you close out a trade prior to expiration. So for example, here, if I've sold this, let's say I'm bearish on Goldman for whatever reason, and I sold the 240, 250 call vertical, and the stock ends up between 240 and 250, you want to make sure you close it out because you're at risk of assignment on the 240 that you're short, but the stock hasn't reached high enough for you to exercise that 250 call. So that's really where you want to make sure you want to pay attention to. If you end up in between the two strikes, that's when you want to make sure you close it out before expiration. Otherwise, you just let it expire worthless, or the two legs can offset each other if it goes above 250. Are there credit spread trade ideas? So I think I already answered that question here. Any last questions? How far in advance should a position be closed if it's in between the two strikes? You should close it up. I mean, you can close it out a few minutes before expiration Friday, but I usually like to start working those orders by noon, because sometimes they could take a little bit of time to close out. But worst case scenario, you can always put in a market order if you're very close to the expiration. But usually I like to close them out on Fridays. That's what I do before expiration. Can I use credit spreads in an IRA? So that depends on whether you have the ability to do that. You should be able to do that. And again, credit spreads is something that you have limited risk with. But it depends on whether you have the ability to sell credit spreads or not. That's a question for your brokerage firm. Tom's asking trade ideas with ETFs. So we currently don't provide trade ideas on ETFs because we don't calculate technical scores on ETFs. This is really where, again, when you're trading ETFs, this is really useful for overbought, oversold. So for any of you that use these types of oscillators like MACD, RSI, stochastics, you can use all of those to help you look at those ETFs. I would prefer, and one of the key things about actually selling credit spreads is that you typically, when you sell credit spreads, you do them over and over again on the same stocks, as opposed to debit spreads. You typically trade debit spreads all the time on lots of different stocks. So that's really one of the key differences between trading debit versus credit spreads, is that you may end up following the same ETF over and over again, selling credit spreads on that one ETF because you follow it all the time and you're familiar with when it's overbought, when it's oversold. Versus debit spreads is something that you're constantly looking for new ideas for. So credit spreads it's typically not something that you necessarily have to constantly find new ideas on. It's more something that you trade the same ETFs you sell credit spreads on over and over again. Any last questions? If there's no other questions, I just want to thank everyone for taking the time out this afternoon. I hope you guys found this webinar useful. Like I said, for those of you that are relatively new to these types of spreads, I highly recommend you to look at the recording on debit versus credit spreads. I go into much more detail between the differences between the two. Again, very, very different strategies used in very different times. Make sure that you understand the differences and use them correctly.
Okay, thanks, Tony. Appreciate you going through everyone's questions, and thanks to everyone who submitted questions too. We're seeing a lot of engagement with the OptionsPlay tool, so there's a lot of questions, and it's just getting more and more popular to use this OptionsPlay feature. Once again, if you haven't used the tool, it's there across the top in a tab. You can find OptionsPlay. If you have any problems or issues, please contact the customer support team. And for our next webinar, it'll be September 5th. That'll also be an OptionsPlay webinar. And then a week after that, we have another webinar from the Options Industry Council. But the next one coming up will be September 5th. We'll be joined by Tony again from OptionsPlay. Thanks again for everyone for taking the time to join our webinar. We really appreciate all the attendance and the engagement. If you have any other questions, please contact your brokerage support team. And as mentioned, we will be emailing out a link to a recording of this webinar. If you registered, you should be receiving this link. And we wish everyone a great rest of the day. Bye-bye.